Today we'll talk about the difference between volatility and risk, and why does it even matter? So back when I was in grade school, probably about third grade, I remember doing some basic geometry when the teacher threw a bit of a mind-bending fact at us. She said, "Remember students, a square is a rectangle, but a rectangle is not a square." Now truthfully, most of us understood the distinction, but I remember my teacher dropping it out there like it was some sort of fascinating riddle. Anyhow, I'll spare you an explanation of the similarities and differences between rectangles and squares because I'm pretty sure you already know that. The reason I'm bringing it up is because it will serve as a helpful metaphor as we outline the similarities and differences of volatility and risk. All too often these words are used interchangeably in the world of finance, but each has specific characteristics that we should understand so that we don't overreact to one or the other. Let's walk through the details of each of these concepts to better understand why they need to be viewed distinctly. To begin with, let's talk about risk. In a financial sense, risk is the possibility that you won't be able to meet your financial goals due to an unforeseen change. There are many types of financial risk. There's credit risk, market risk, timing risk, sequence of returns risk, currency risk, concentration risk, political risk, liquidity risk, systematic risk, inflation, legal risk, strategic risk, and I'm sure there's many others. Now when you put it in a long list like this, it kind of makes you wonder how safe your money really is, doesn't it? Or maybe you understand these risk factors and it doesn't concern you much at all. The truth is, risk is inherent in everything we do. There's just more PhDs in the world of finance creating names for it, so it seems like your money's in greater danger. To help us understand risk better, I thought of a few things that were unforeseen circumstances in my lifetime that were interesting to me. The first one was back in the late 90s when Firestone, the company that makes tires, had to recall millions of tires because of a manufacturing defect. Their stock suffered badly through that. Just look at where we are now in 2024. Bonds haven't exactly done well with rising interest rates over the last year. For that matter, the stock market hasn't seemed too enthralled at times. Going back a little further to COVID, if you remember GameStop and AMC, when there were a lot of hedge funds shorting those stocks, a group of internet gangsters basically decided to drive the price of those stocks up, forcing those who shorted the stock to buy them back at super high prices. Speaking of COVID, I hope you didn't sell everything you had in the middle of March 2020 when the market took a big dip. That bad timing would have cost you big time. Or suppose you're more conservative and left all of your cash in high yield savings throughout COVID. If you did that, I doubt your account was able to keep pace with the record inflation we saw in 2021 and 22. The fact is, risk is everywhere. We can't ever totally escape risk. We can only establish strategies to mitigate it. The purpose of this video is not to address specific risks. I just want to provide a few examples to show you how abundant risk really is. If you want to learn more about managing and investing risk, we've got a post on our website about asset allocation. I'll put a link to it down below. All right, next we want to define volatility. So for the purposes of this video, volatility is the measure of how much the price of an investment increases or decreases relative to its average price. This is commonly measured using a tool called beta in stocks. It evaluates the volatility of a given stock relative to changes in the overall market. So the overall stock market has a beta of 1. If a stock's beta is greater than 1, then the stock has above average volatility. If the beta is under 1, then the stock has below average volatility. If a stock has a beta of 2, then the stock has twice as much volatility as the stock market as a whole. And if it has a beta of 0.5, it has half as much volatility as the stock market as a whole. Now, volatility in stocks is higher than most other investments because stocks trade more easily and frequently. When I was preparing for this video in May 2024, the Nasdaq's 10-day trading volume was just under 16 million trades per day. The New York Stock Exchange was around 4.3 million. Now to be clear, that's trade contracts, not the number of shares that were traded. The number of shares is actually well over a billion per day for both exchanges. Now every time a stock is traded, a buyer and a seller have to reach an agreement on a sell and purchase price. This process is almost always managed by market makers that connect buyers and sellers on an exchange. Really, that's mostly done electronically nowadays. But most trades occur at a price that is either above or below the price that the trade before it occurred at. So every time that a trade happens, it moves the price of a stock up or down. That's why the price of a stock is always moving. If you watch a ticker, for just a few seconds, it'll go up and then it'll come back down. Maybe go up, 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 and then down, down, down. It never stops moving. Now, this constant movement in the price of a stock is a major contributing factor to its beta. Another major factor is how far up or down the price moves as a result of that trading activity. And clearly, the prices of some stocks travel much further from their daily starting points than others. So generally speaking, the easier an investment is to trade, the more volatile it tends to be. Since stocks are easily traded on an exchange, they can be accessed by nearly anyone from almost anywhere on earth. Stocks tend to be more volatile than many other investments. So generally speaking, the easier an investment is to trade, the more volatile it tends to be. Since stocks are traded on an exchange that can be easily accessed by nearly anyone from almost anywhere on the earth, stocks tend to be more volatile than many other investments. By the way, if the information in this video is helpful or interesting to you, please click like and subscribe below. That will help our channel to grow. You'll get notifications or be more likely to be notified whenever I do post videos, and it'll actually allow me to continue making videos so I can help people learn about personal finance. Well, that's great, Curt. I see the distinction, but why does any of this matter? So the problem is many times people confuse volatility with risk, which could potentially discourage them from buying an investment they would be better off holding. So to help unpack this, let's look at an example comparing two investments with very different levels of volatility. So check out this chart on your screen comparing the performance of Vanguard's Total Stock Market Index Fund, that's VTSAX, and Vanguard's Total Bond Market Index Fund, VBTLX. Now quickly you can note how the price movement of the stock fund has been more active or volatile over the preceding 3 months than the bond fund. The daily ups and downs of the stock fund are clearly larger based on this visual illustration. Now overall it looks to me like each investment spent about as much time going up as it did down, but the rises and drops were obviously more significant for stocks. So a common conclusion from a graph like this is that stocks are riskier than bonds. And if you were trading these two funds on a daily basis over a short period of time, you'd absolutely be right. Just based on 3 months of activity, it's clear that if you lose money from one day to the next while holding the bond fund, your losses will be more limited than they would be in the stock fund. But what if you held these investments longer? Would that change the level of risk if the volatility remains? My personal point of view is that over long periods of time, the bond fund actually exposes you to more risk. To illustrate that, let's look at the performance of these two funds over the last 5 years. Once again, the bond fund has been much less volatile, there's no doubt about it. But what should be painfully obvious to you now is the fact that the performance of the stock fund has been remarkably better. If you annualize those returns, it's 17.3% per year versus negative 2.55% for the bonds. And in case you're concerned that I'm stacking the deck by choosing a favorable date range to make a point, here's the graph going all the way back to 2001. There's no contest here. Even with the lost decade for stocks, their annualized returns were 17.77% over this period, while bonds returned negative 0.32%. Inflation during that period was 3.38% annually, which is really the basis of my argument that over the long term, bonds are actually riskier than stocks. By extending the investment horizon, the risk of inflation grows in importance, even if it's been there all along. The bottom line is no one can indefinitely afford to accept returns that are outpaced by inflation. Stocks are clearly a suitable way to address inflation, but bonds, dare I say, are more risky. And I haven't even addressed the risk that you won't actually have enough money saved and invested when you reach retirement. Now, none of this is meant to suggest that bonds will always be outpaced by inflation. The last 24 years have been really terrible for bonds. Make that remarkably terrible for bonds. But over the long haul, the fact is stocks tend to be relatively safe. Time has a way of addressing the volatility. Just like a rectangle is also at times a square, volatility can be a contributor to risk, but just because an investment is volatile, it doesn't mean it's risky. Time is the ultimate antidote for volatility. From a higher view of the graph, the broader perspective, we can see the daily ups and downs just aren't as important as the net gains. Stocks provide a much better option for outpacing the impact of inflation. In fact, I'd even be willing to argue that over the long term, stocks are a relatively low-risk investment. The question is, how long is long term? Well, for me, if you're talking about a diversified portfolio of stocks that you're no longer contributing to, 7 years is a sufficient period to outlast an extended dip in the stock market, assuming again that it's a diversified portfolio. If you're continually buying more diversified stock funds, then 5 years should be efficient because by making contributions, you're effectively dollar cost averaging, which reduces the risk that you'll buy at the wrong time. Now, on average, the stock market has a down year 2 out of every 10 years. Of course, that could mean that there are 4 bad years in a row out of a 20-year span, or 6 bad years in a row out of a 30-year span. So it's not as if the risk is non-existent. It's just much lower with more time. Another thing I'd like to point out from the graph is the way time has a smoothing effect on the volatility of stocks. And don't get me wrong, the day-to-day volatility is still there. It's just harder to notice when you scale back to look at a broader number of years. I like to picture stocks kind of like a mountain road. There may be some bumpy patches and there will certainly be ups and downs, but overall the journey is taking you higher and higher. Bonds are sort of like a street in a boring neighborhood. It's safe, well lit and smooth, but the ride just isn't that impressive, and you certainly don't want to be there for an extended period of time. Likewise, bonds are great for getting you through intermediate periods of 2 to 5 years where you just can't accept the risk of a sudden hard downturn in the value of your stocks. But for those of us who are trying to build adequate portfolios for retirement, bonds are not the best long-term option. Again, I don't want to come across as a bond hater. There's certainly a time and a place for bonds, but I do want to challenge the narrative that stocks are risky and bonds aren't. There are plenty of examples where the statement is true and plenty where it's false. As usual, the devil is in the details, and one distinguishing detail is knowing the difference between volatility and risk. Hopefully understanding those differences will make you a better investor. As always, we are grateful for your interest and your time watching our videos. God bless and take care.